Okay, so welcome everybody. So today we have Arpur Gupta, who is going to talk about demographics technology diffusion evidence for mobile payments. So we are very happy to have him. Boris Vallée will do the discussion. So if you have questions, so please, raise your hand or drop them in the chat, and we'll try to, pose throughout like the seminar and ask the question to Arpur. Yeah, so Arpur, you have 40 minutes and Boris will have 15 minutes after.
Great, thanks, Camille. So for those who don't know me, I'm a bit of an outsider to this crowd. So let me just introduce myself. I'm Apurv. I'm an assistant professor at Dartmouth Economics Department. I broadly work on forums in developing countries, so trying to understand like what are the barriers to their growth. And a part of my portfolio tries to look in adoption of technologies and their diffusion, the barriers to those process. And this is paper number 2 in that agenda with a bunch of same co-author, Nicholas and Filippo. And for this project, he's also teaming up with Pula Ghosh from IIM Bangalore. So as I said, the project is trying to understand how demographics or the role of demographics for the process of technology diffusion. And we'll use mobile payments as a case study for this process. So the motivation of this project came basically from a very stark evolution of age distribution across nations. We know that starting in 2020, developed countries are much more older and developing countries are much more younger. On the right tail, you have countries like United States and Japan, who are much older than countries like India and China, which are much older than countries in Africa. But more importantly, there's also a trend that is going to follow, in which we know that, like, as per projections, and these are actually before COVID data came into account. Like, we know that the world is going to become older 50 years down the road. And we're trying to understand what are the consequences for this, for the process of technology diffusion. Now this has taken, or this evolution of aging has been appreciated more recently in the economics literature, where people have shown that either younger population is actually the driver of innovation in the economy. On the other side of the spectrum, you have papers which argue that an older population is going to incentivize development of new innovation because of labor-saving technologies. So an older population creates a larger incentive to produce technology which are more labor-saving. Now, in this paper, we take a complementary yet different approach, whereas instead of the process of innovation itself, we're trying to understand how the process of aging affects the technology diffusion or the diffusion of technologies. And this is going to be a much more centric issue in consumer-facing industries, where user preferences might dictate what kind of technology is being preferred by a particular subset of consumers. For example, preferences of technologies may differ across cohort of consumer, which is one dimension of demographics, which is older people might prefer to use different kinds of technologies than younger cohort. But the punchline that we're going to argue in this paper, or the broader implication of this, are going to be that if businesses internalize their consumer preferences, then an aging population may slow down adoption of technology. Or the corollary is that a younger population, on the flip side, might actually advance the adoption of new technologies. And that's what we are going to argue in this paper, and we'll examine this hypothesis by focusing on the rise of mobile payments in India. Now, mobile payments, as I'll argue, is like a very nice technology to study because it has broad consequences for financial inclusion and upliftment of poor population. And we'll do that in India for a few specific reasons based on the richness of setting as well as for identification. What we'll show in this paper is, first of all, just some correlation. We will begin with some correlation, which is that age significantly explains the preference of mobile payments, where young consumers are going to use more mobile payments relative to older technology, or in our case, it's going to be traditional cards. So again, just some correlations to begin with. Then we'll develop a technology adoption model which I'll not cover today in interest of time. And we are also updating this model recently to draw counterfactual. But the model is pretty simple. It has two ingredients, that firms face different consumer base, either young or old. And these younger consumers are characterized by their preference or higher preference for mobile payments. Now, the implications from model, just these two simple components, drive two things. One is that age directly affects the use of technology in the on the consumer side, but then indirectly it affects the adoption of technology on the firm side. That is, small businesses, when they face more younger consumers, they end up adopting mobile payments more. And hence, the diffusion of technology is going to be much slower when the potential consumer base faced by the firm will be much older. We'll then take these predictions of the model and use a rich setting and identification strategy to test the implications using a fintech's introduction of a mobile payment technology in 2019. And I'll go in more detail about all these, like what's the technology, what's the setting, in detail in a few slides. But we'll indeed show that firms that have a much more potential younger consumer base, or they face larger demand from younger consumer, they will end up adopting these mobile payments significantly more as compared to firms that face an older consumer base. Okay. So I see some chat. Let me take a pause here and see. Oh, it's from Camille to raise their hand and ask questions. Okay, so let me reiterate. Please interrupt me whenever you want. If you have any questions, I'm happy to answer them on the call. Okay, awesome. So the roadmap is that I'm just going to talk about background of mobile payments in India. For those who are unaware of this is actually really fascinating. For all the frictions that you think about in developing country, India is right now at on the forefront of payment revolutions. And my hope is to shed some light and provide some learning on this setting. Then I'll show some correlation on the consumer side using rich bank data on how consumers across different age cohort end up using these different mobile payment technologies. And third one is going to be more empirical strategy and identification based strategy, where we'll see whether firms internalize these consumer preferences in their adoption decision, and what is the role hence of demographics in firm adoption decision. And then I'll conclude and provide some next steps of the paper. So let me just start with the background of mobile payments in India. So over the last decade, basically, or decade and a half, the electronic payment landscape in India can be characterized in three phases. Phase one was characterized by evolution of traditional cards, where India had all major players in the card space. Basically, think of MasterCard, Visa, the duopoly in US. But in India, it was actually also much different because there was a nationalized player called RuPay, which basically did not kind of damage the duopoly maintained by these two card players. By 2015, however, card accounted for about 90% of the electronic payments. So let me be just clear on the get-go. This paper is not about cash. Okay, we're thinking about transition from a traditional card payment technology to a new technology of electronic payments, which is mobile payments, which was phase two in India. So phase two was a transition from these traditional cards to mobile wallets, which was the first phase of mobile payments in India. Now think of this as your Venmo or Apple Pay. Okay. So you could preload payment from your bank account into this digital wallet using a digital device, which was ubiquitous in India. India has a very high smartphone ownership because smartphones are cheap and data is much more cheaper compared to developed countries. So you could easily use mobile wallets for transaction in India, and it became actually very popular after cash shock in India, where government banned cash for a period of 2 months, which created temporary incentives to use these mobile wallets, but also led to a long-term adoption decision, which we have discussed past in one of our paper, and also has been shown in Boris's work more recently in his JF paper. Now, the third phase that happened was this mobile payments transition to a thing called unified payment interface, which was the game changer for payment landscape in India. What it allowed, basically, think of this United Payment Interface, UPI, as a centralized system which allowed different payment apps to talk to each other. So before, let's say Kamal was using Apple Pay, I was using, let's say, Venmo, and Song was using Google Pay. We all needed the same app on the other side to be able to transact each other. So I could not transact with Kamal or Song because I didn't have the same app. But with UPI, the playing field was leveled. This was centralized interface, which all apps basically could link to. And now I could transact with Camille as well as Song using a different payment apps. And it allowed real-time bank-to-bank transfer. So I could transfer money instantaneously and allowed for this interoperability. Now, this was introduced in 2016, but it took off in 2017 in India. Now, when I'm asking you to think about electronic payments, think about a combination of these three things. But within that, we are going to either think about mobile payments, which is combination of mobile wallets and UPI, or we are going to think of traditional cards. So the technology is either going to be traditional cards or mobile payments. Okay, and I'll talk about distinction in these two from a consumer experience in a couple of slides. So this is the evolution of mobile payments versus card in India, where on the y-axis, we are plotting the share of mobile payments over the total electronic payment volume. And we do this between 2016 to almost 2021. And you see that like before or like earlier 2016, the volume was much lower, about 10% to 15%. It jumped around demonetization, which happened around this point. It dropped a little bit, but then kept on happening. And right now, as we stand, this is about 90% of the total volume. So a really, really big deal in how people transact in India right now. So the main distinction from both consumer and merchant sides between mobile payments and cards are the following. The first thing is that mobile payments have a much lower adoption cost than credit cards or debit cards. And this is from the consumer side. So as I said, compared to traditional card, you don't need to go and apply to a bank. So that saves a lot of your non-pecuniary costs, but also a lot of pecuniary costs in terms of application fee and things like that. Or on the other side, for mobile payments, you already have a lot of infrastructure built up. All you need is basically an app if you have a mobile phone and data. So condition on having a mobile phone across two consumers, applying a card, it's much more expensive, whereas using mobile payments, it's much more cheaper. But from the merchant, it's actually even much more different. For merchants, think about a merchant trying to accept card. The merchant needs to basically buy a POS machine, a point of sale terminal, which has a fixed cost. It also has a variable cost, a rental fee on an ongoing basis. And even after paying this fixed cost, a merchant incurs an interchange fee. So every time you transact using a credit card in US, you pay about 3% of that interchange fee. And half of that goes to Visa or MasterCard, and half of that goes to the bank. Whereas with the UPI or mobile payments in India, the government mandated 0% interchange fee. So it was basically literally zero variable cost for merchants to accept this payments in terms of both fixed cost and variable cost. My point is that from merchant side, this is a dominating technology in broadly speaking. We cannot pinpoint the exact cost everywhere, but broadly, it is a dominating technology in terms of cost. And it also provides a very different consumer experience. So first of all, instead of a physical card, the way you transact as a merchant is you need a QR code. So consumer basically, as you would have done using a Venmo, you scan your QR code on the app, and then you can make the transaction with a counterparty. And then like for merchants, what it does is it basically gives them a security. So for example, in case of our app, as soon as you transfer, the merchant gets either like a notification through like a ping, where the cell phone pops out with a noise, a ping like the payment accepted, or basically sends a notification that the transaction has happened. So it's basically an instant clearinghouse, this payment app for the merchants. So as I said, in the experience, yes, Camille.
You have one question in the chat from Elvira. So who is asking what's the generalization of your setting to innovation and technology in general? So can you talk a little bit about this?
Awesome. So this is a great question. So as I said, this is like a case study that we have in mind. So relating to your point that you mentioned, may not be very relevant to carrying out an activity or affecting TFP. I agree. We're not taking a stand on TFP here. But in all these production models, like if you just write a simple production model of a firm, normally firms adopt technology to lower its cost. And that's what we have in mind here. So we have an equivalent of a technology which reduces firms' cost. It might not make it more productive, but at the end, firms care about profit. And increasing their TFP is one way. So that's what we have in mind. So there's not going through TFP, but still going through a cost-reducing technology. Alvaro, I hope I answered your question. If not, please free to unmute yourself and let me know. Okay. Awesome. This rise in impressive shift in card to mobile payment is pretty striking when you compare this trend in relation to other countries. US and Europe are still mostly card centric, even when the technology has been developed. It is not being used on a wide scale. Now, there are multiple reasons. In 2023, Apple Pay only accounted for 3.1% of in-store transaction in the US, which, as I said, can be attributed to multiple reasons. But like in this question, we asked whether demographic could be one of those reasons that explains some of these differences. Now, this is not a paper about this cross-country analysis. We want to basically go very seriously into trying to estimate this, and to do that, we need to focus within a country to be able to rule out like differences across institutions and other things, and focus on the mechanism that we have in mind. So we'll do that in India using a bunch of identification strategy and institutional settings. Okay. So let me just start with providing you on the consumer side what is happening in terms of preferences. So what we'll do is that we'll use data from one of the top 4 banks in India. For that, we see a full account information on about 200,000 consumers between January to February 2020. Now, the age distribution of this population is closely representative of Indian households, the head of Indian households, which is nice because we want to claim that we are representing the country. However, because this is like already banked population with a large bank, we normally have more wealthier individuals compared to a typical Indian households. That is not a problem by itself because the marginal consumer that we have in mind who will use the technology is much more wealthier than a poor person. So the advantages of this data is that, first of all, we are able to measure individual age of the household. And because we have the transactional diary of the household, or the individual, like basically we are able to construct a share of mobile payments over the total electronic payments that the individual has. So we then start by asking that does age indeed explain relative use of mobile payments versus traditional cards? And to do that, we ask like simple question, like we do like a variance decomposition analysis. I think Song has also done this in one of his paper, where we basically just decompose the variance on a bunch of characteristics that we have on the consumer, including age and various different demographic variables. And we indeed see that. So this pie chart basically plots that variance decomposition, where we see that age accounts for almost as much age can explain as much variance in the share of mobile payment usage as location, which is pretty big. Like location by itself, like space already determines, like we know from like past research, determines the diffusion of technology. But we say that even condition on age, we are able to explain 40%. Even condition on location, we are able to explain 40% of variance in the use of mobile payment just by age. There's almost no relation, very little explained by wealth of the individual or the occupation or other demographic characteristic like their gender or whether they are married or not. Now here I have not told anything about the relationship. It just says age explains a huge part of variance in the use of mobile payments. So
just a question from the chat, Arpur. So, yes. So would it make sense to look at the use of technology by firms instead of individuals?
We will, and we will. Just give me 5 minutes. That's exactly the question. We are actually so you are a little bit ahead in terms of what you're asking. So first, I need to establish consumer preferences exist in a particular way, and only then I can weigh headway, and only then I can make some headway on how firms internalize that. So I'm going to exactly talk about that right now. We do not have firm age though. If you're alluding to that, we do not have the firm's age or like firm's owner age. And that's why the focus is from consumer to firms. And I will get there in about five minutes. Okay. Awesome. Then we ask that indeed are younger individuals using mobile payments relatively more. And then we just start with a simple bin scatter. Again, we're not taking any stand on causation or anything here. We'll have a model soon in the paper which endogenizes this through habit formation, where you can think of older people born with a particular set of technology, born during a particular set of technology, and there's some stickiness in what you use, which fades slowly over time. And that will generate this particular distribution or this particular relationship of age with the share of amount transacted. And we see that indeed, like the younger you are, the more you are likely to use mobile payments. Indeed, like if you are the youngest in the youngest quartile of the population, you use mobile payment as much as twice compared to the oldest quartile. Okay. So one thing I do want to point out here is that, like last week, we had a discussion of this paper in a different conference, and it was pointed out by discussing that the same relationship hold in Brazil. In fact, like historically the same. So in terms of external validity, we are trying to reach there using like data from other countries, and in the next iteration of the paper, we will show that this is indeed a worldwide phenomenon, or at least to the best extent possible, we can show that. Elephant in the room is that maybe younger people are different than older people. As I said, we're just documenting correlation. The thing we do is that we basically in the paper include a battery of control, including wealth, your location, and this relationship indeed holds and is pretty robust. One thing we do, which is not in the paper yet because we did that recently, is that we acquired a panel of a data on panel of individuals. And I'll come back to the question in the chat. I see someone has wrote something. So what we see is that in this panel of consumer, where we see like a consumer over time, we try to see the evolution of mobile payments between 2016 to 2022. And what I'm plotting here is that I'm plotting the estimate on the share of mobile payments by younger population, where younger population is defined at 40 years or below. So what we see that indeed younger population by January 2020 is 20 percentage point more likely to use mobile payments relative to older population. It actually grows from like, so UPI, which was not there in 2016, like starts growing up, stabilizes around 20, peaks around 2020 at 20 percentage point difference, but now stabilizes around 15 percentage point difference between young and old population. Okay, so let me just finish the slide before taking the question, and what I'm doing here is just summarizing that age indeed explain a lot of variance in the use of mobile payments, and indeed young individuals are using mobile payments relatively more. Okay, it's just thanks. I'm glad. Okay, awesome. So let me take a pause if someone wants to ask a question by unmuting themselves. Okay, so once I've established this consumer side, as was asked in the question, we ask the broader implication of this, that how do firms' adoption decision depend on the underlying demographic structure? So in the model, we basically have a simple prediction that the model predicts that the propensity to adopt mobile payments is higher when businesses face more younger consumers. And we ask whether this is indeed true in the data. The way we do this is the following. Think about a company in India, which is analogous to Square. Many people would have used Square for transaction at a retail shop, right? You go, you basically have kind of a credit card swiper, or nowadays like a machine which accepts QR code. Think about that in India, a company like that in India. Before 2019, the company was only providing POS terminals to its small business consumers. But because this UPI was growing so fast, the company decided in May 2019 that we are going to introduce, or they are going to introduce, a QR code based technology. And this is a very, very, very simple technology. I cannot stress enough the simplicity of this technology, that they basically sent everyone a simple QR code placard to put on the front of their shop. Okay, and consumers can use this to transact. If someone does not receive it, they could go easily online and take a printout of that and put it on the shop. Okay. What we see is that then, like, we ask whether before and after this technology was introduced, how does the age across district determine when the firms are going to adopt or start using this technology. Okay, so classic difference in difference, where the before and after are going to be this May 2019, or when the firm gave this technology. And the spatial dimension, or the second difference, is going to be across space, which is across district, different age composition. Okay, and in India, you have a very nice distribution of age composition because of historical reason, which I'll get into in a while. So as I said, it's a traditional two-way fixed effect DID model, where the Y, or the main dependent variable, is the adoption rate, which is the number of stores joining the platform in district D in a particular month, divided by the total number of retail firms in a district in the last census, which was 2015. We include district fixed effect, time fixed effect, and the coefficient we are going to be interested is the loading on this share of young population month by month. Okay, so we basically create like a standard deviation. We normalize this variable by having mean 0, standard deviation 1, and we ask month by month, before 6 months and 6 months after May 2019, what's the adoption rate in that district, depending on the share of young population in that district. So as I said, like the first Smells test is that there is no pre-trend. We'll just start with the OLS. Okay, nothing causal here still. So just simple OLS, and we see that after, or like by quarter one, or after quarter one of this May 2019 policy, the adoption rate increases by 1.5 percentage point. Okay, now this is, you might think this is small, but actually like in response to this one standard deviation increase in younger population, a 1 percentage point increase is actually about 25% increase relative to the baseline adoption rate. So these are pretty big increases that we are seeing. Now again, the elephant in the room is that there are three major concerns. Concern number one is that areas with a younger population are going to be much different. And indeed, we see in our data that indeed, so this is just a univariate regression across multiple variables where I plot the estimates, and we see indeed areas which are younger are different in their population. They're more rural. They're less literate, and they have a larger share of working population. So we're not taking a stand of whether this is causal or not. But notice that even in this case, like, what is happening is that areas which are younger are actually not more developed. They're actually less developed. So if anything, they should have predicted our estimates, or they should have downward biased our estimate, because more rurality implies less adoption, right? So I'll talk more about this. What we do is that we include these controls, these baseline controls, which are different across areas, and we indeed see that our coefficient actually jump up. The second concern is local dynamism. So even if there is none of this omitted variable bias, it could be that what is happening is younger areas are like Silicon Valley. Everyone wants to go there, right? And because everyone wants to go there, that is driving both the youngness of the area and also the adoption decision. So there is some kind of like same variable that is driving both forces, and hence that could be the thing that is driving our result. The third thing is that just some other district level confounders, so just some unobservables that we don't know about. The way we are going to address is basically the remaining part of my presentation, remaining 10 minutes. In the first one, we basically include all these baseline controls that vary across districts, depending on their youngness, and interact them with the month fixed effect. Okay, just including battery of controls in our OLS regression. To address this local dynamism broadly, and also relate a little bit to like this omitted variable bias on unobservables in point one, we basically use an IV approach where we instrument the demographic structure, the age structure of the local economy, using historical determinants of fertility rate in India. Okay, and I'll talk more about it when I get there. The third thing is that even like after like an IV, which is a district level IV, you might think of other district level unobservables driving our results. So what we do is that then we do make a district level or within district level comparison. And what we do is that we compare within district areas which have a university to areas which do not have a university. And the idea is that areas with university will have more local demand just by the nature of it coming from younger consumers. And hence, we should expect a higher adoption rate in regions that have a larger consumer base, which comes from these universities. Okay. So let me just start by showing you the there are some questions. Sorry.
Yeah, yes. A few questions from the chat. So let me read them. Yes. So the first one is like, is this relationship driven by younger entrepreneurs being more willing to adopt mobile payments or demand from consumers for acceptance of this payment method?
So let me just answer this first, which is actually, Michael, like that is the distinction that we want to make here. This is not about like age of entrepreneurs per se, which would be a supply side mechanism to drive adoption rate. What we have in mind is a demand side mechanism, which is the second thing you allude. And we do not, so in all fairness, we do not see the age of the entrepreneurs here. And that's why we are doing this third test, which is basically a within district analysis by comparing pin codes which have university to pin codes which have which do not have university. And the assumption there is less stronger, which is that there is no reason to believe that entrepreneurs in university area are younger than entrepreneurs in non-university area. So the mechanism we have in mind is not about entrepreneurs age, which has been shown a lot in the literature that it matters for adoption decision. We're thinking about demand from consumers for acceptance of this payment method and how that internalizes into firms' decision making. Okay.
Yeah. Another question from Michael. So he's asking whether this, there is a relationship between age and adoption when it comes to mobile versus cash.
Yeah. So I mean, I don't think I know India better than you when it comes to this question. As you read, like cash is a very hard thing to argue anything about. What we see in the data is ATM withdrawals. And indeed, there is a relationship in terms of ATM. Like ATM follow the same trend. If I include ATM withdrawals in this result, the relationship holds. That's all I can say. Like we do not see cash transactions or anything, and hence we are not going there. Think of this as like cash as the most redundant technology, but which comes with its own like benefits and cost. But we are focusing on the next step, which is card and mobile payments. So that's the best I can answer here your question. We really do not see cash transactions to make headway. Okay.
Yeah, and another question from Jin Choi. So he's asking if the data shows that there are more young populations in rural area in India, could this be generalized to other settings where there are more young population in urban areas?
No, that's a great question, and this is how debate amongst our co-authors started, that OLS plus this controls are not going to help because of just exactly these things, like what is the external validity of these things. Hence, I'm going to talk about the instrument available in my next slide, which basically addresses these things about like, can we generalize this to other settings where it might be more urban than rural, okay? And let me just get there. So what we do to address these
time. Oh, sorry, just in terms of the time, you have 7 minutes left.
Yes. So what we do is that we address these concerns. For example, that maybe it's India where it's like rurality driving stuff, although rurality drives against it. But still, some could argue that urbanity or other omitted variable bias could basically affect this relationship. So what we do to address this is basically we use the historical determinants of fertility as an instrument for share of young population. And notice we are not going to use fertility per se, because that could be also function of like urbanity or like medical facilities in a region. What we use is, so let me just first lay down the idea. The idea is that area with higher expected fertility in 1990s are going to have a larger share of young population in 2010, right? If you're more fertile 20 years before, you're going to have more children 20 years later, right? And those children will be younger. And this is going to be variation or is going to be orthogonal to recent migration trend. But fertility by itself could be driven by various factors, which are unobservables, even observables. So what we do is that we basically rely on district level sex ratio in India in 1990s. the idea is that a skewed sex ratio, that is either a higher male per female or higher female, or higher female per male, are going to affect the marriage market and hence consequently fertility. And the reason for that is embedded in institutional details in India. There are three things in India that I want you to remember. One is that India is a more monogamous market, less polygamy. The divorce rates are low, much low, because marriages were arranged and it's just cultural norms dictate that. Third is that the children are not born outside wedlock. Okay, so these things make us believe that this is a nice setting to exploit the sex ratio as an instrument for share of young population going forward through the channel of fertility. Okay, so this is just some non-parametric regression where we see sex ratio 1991 across districts. So about 500 districts on this bin plot, and then age structure in 2011, which is the last census that we have. And on the y-axis is basically share of population that is young, and sex ratio is basically on the x-axis. Now we're not taking any stand on optimal sex ratio. What is optimal? What we want to just see is that is there a skewed relationship, and indeed the relationship is inverted U-shape in this setting. We then make a more formal parametric approach where we in the first stage, we basically fit like a simple quadratic function. We could be pretty parsimonious here, but we don't want to take a stand on what the relationship is. So we start by fitting a second order polynomial, and we see that indeed the slope on linear component is positive, whereas the quadratic component is negative, which is in line with the non-parametric graph that you just saw. In the second stage, we basically instrument our variable. So we have two endogenous instruments. So we only do a IV to SLS where we predict the age structure using these two instruments. And we indeed see that the adoption rate is about 2 percentage point higher in response to a 1 standard deviation in young population. And just to show this in graph, we again see no pre-trend. What I want to talk about is this estimate. If you remember in the simple OLS, the estimate were about 1.5 percentage point. They jump almost 3 or 4 times when we include this IV, which is also higher than OLS with controls, suggesting that indeed there is some unobservable bias driving downwards our estimate in OLS. Okay. Now in the final step, what we do is that it could still be argued that, for example, like age of the entrepreneur is what is driving adoption rather than in them internalizing the age of their consumer base. So while we cannot address this question directly, we're trying to get data on age of entrepreneurs across districts or pin codes in India. We are not there yet. But the idea is that within a city, we basically use the fact that neighborhoods within a district will have, some neighborhoods will have university and some will not. And but the neighborhoods that will have universities are going to have more demand coming from consumer base, which is younger, because these are just temporary migrants within a day. In that region, people travel from their home to university, study, consume there, and interact with merchants. So the idea is going to be that we're not good. So we basically collect data on all Indian universities, which is about 1,000 or 1,500 in India, and see their exact location in pin codes. Pin codes are much more narrower than districts. So what that allows us to do a district time fixed effect and compare two pin codes within the same district, one with university and one without university. And we do the same event study plot based on that. And what we see here is indeed, so we are not able to do percentage point because we do not have number of firms at pin code. So we are doing this in log terms. And this actually, the estimates are actually quite close to the overall increase that we see using our I, which basically points to indeed the underlying demand of consumer plays a big role. So let me just plot the final test, which is that what we see is that we basically separate industry into consumer-centric and student as consumer industry and everything else. So the idea is that if consumers are indeed driving, or the consumer demand, student consumer demand is driving this effect, we should see this only coming from industry, which are catering to those students. And we see that is indeed what is happening, whereas there is no different evolution in industries that are not catering to those consumers. Okay, so let me just wrap up and yield the floor to Boris. We are basically just showing that mobile payments, like first of all, like surpassed electronic, other form of electronic payment between 16 to 20. And we are trying to understand the role of demographics in this huge increase that India saw. And using model and data, we indeed see that demographic differences may explain the diffusion of new technology, and older society can be slower at picking up technology. Now, the next step or next iteration of the paper, which will be available in the next 1 to 2 months, is going to actually quantify these effects more precisely. And then we are going to interact these demographics with network effects to see distribution consequences, where if you have a lot of younger population, if you have a young population living in a lot of older population area, then because of this network effect, a lot of firms might not adopt the technology and hence younger consumer might suffer. So we're going to do all this counterfactual using our more enriched model in the next iteration. I'm looking forward to Boris.
Thank you. So Boris, you can share your slides.
Can you see it? Very good. Well, thank you very much, Camille and Song, to ask me to discuss this very interesting paper. So Arpov did a great job presenting the paper, but basically, in a nutshell, there are 3 parts to the paper. There is first a stylized fact, a central stylized fact that age is highly predictive of the use of a new technology, in that case, a mobile payment, and that this prediction is coming straight from a monotonic relationship, I mean decreasing with age. Then there is a model that yields the main prediction that business that target young customers are more likely to adopt that technology due to the preference of their client base, and there is some comparative statistics around the cost of adoption, and therefore that this is going to matter more when the firms are targeting young customers. And last, there is a third part which is around causal evidence of the relationship previously documented. Very good. So Arpov showed that. I mean, he skipped the model in the interest of time, I'm guessing. Very good. So I think my main reaction to the paper is to push the author to clarify exactly what we are learning from their exercise. Because I think most of us would come in with the prior that age matters for technology adoption, right? I don't think this comes necessarily as a shock when we look at the world around us. We do observe that it's quite rare for older people to adopt many technologies, and I think, I mean, there is plenty of work around that already, and I like this quote about splitting innovation in 3 buckets. There are the ones that happened before we were born, and they are normal and ordinary. There are the ones that happens between you're 15 and 35, and they are exciting technologies. And then there are the ones that happen after we're 35, and they are against the natural order. And of course, we would be reluctant to adopt them if they are against the natural order of things. So I think this encapsulate one potential psychological mechanism that would underlie the stylized facts that Arpov showed. But then I think, I mean, there is this basic relationship, but there might be much more nuances to bring to that statement, which would be, I think, quite informative and helpful. Because, for instance, it's not true for every technological innovation, or it is not true at every stage of the adoption of a given technology. So think about Facebook. I mean, it initially was for young kids, but it's not cool anymore, right? And the young kids, they've left Facebook. And it's just all people like us using it now. And if you think about Kindle, I mean, the penetration rate is actually higher for older people because the young people would be using a different technology like their phone. So I think understanding a bit better this cycle, are we making an absolute statement, or is it mostly pronounced in a given phase of the diffusion, and for instance only during the early adoption? I think another question which I thought was important, and I don't think I saw much on that in the paper, was the extensive versus intensive margin phenomenon. Because is it the case that they just don't touch at all the technology, which would be kind of my prior, and which would be consistent with like the quotes I was mentioning, or is it that they use it but less intensively? And I think the results were suggestive a bit of the latter, and I think this is interesting to decompose between these two margins, because the prediction and the implication would be quite different. So this was unlike that first step of the relationship. I strongly encourage the author to like bring more nuance to that message, and I think they can do plenty of that. And I would say, so they have a second step of that, which is that this heterogeneity in adoption pattern are going to be internalized by the supply side, and firms are therefore going to adopt at a different pace depending on their client base. And again, I think this is relatively intuitive, right? I mean that the supply side will internalize a first order heterogeneity in their client base. And so again, here I think maybe being more precise, and I really like the next steps that Apov mentioned around thinking about the strategic complementarities and how they could amplify or cut against this main force, which I think most of us will be on board with. Okay, so let me be slightly of an outlier in the profession, and let me question whether, at least for a few seconds, whether we need causal identification here. And I just put this little doggy picture because I think, I mean, for better or worse, we're in a state where we are meeting Pavlovian reaction from most referees, is that if you bring a correlation to a referee, I mean, that's the bell, and immediately they want the food, which is the causal evidence here. The thing that is a bit specific here is that I don't think we really have much leverage over changing the age of the population, right? So I don't think we will need clear policy implication on that regard. What would happen if we were to change the age? I think the exercise is a bit more of a prediction exercise. And to the extent that we want to predict the diffusion, we actually don't necessarily need to be making a causal statement. We just need to be able to predict in a very precise and robust manner. And so I think it might be worth at least considering whether we should invest most of our effort on the prediction exercise versus doing the more traditional bells and whistles around causal identification that we see in most papers. And I know we all have. I mean, we are living in a constrained world, and there might be a middle ground between the two. But what I thought was maybe the most striking missing part was to engage with how to mitigate that friction to the diffusion, right? So that means that we are assuming that technological adoption is desirable. And I think there are many settings where this is the case. It's not always the case, right? I mean, there is plenty of examples of technologies that have had net detrimental effect. But I mean, this is an innovation group, so I'm sure most of the crowd here is convinced that technology is desirable. And so then under that assumption, so what are levers that firms or policymakers possess to facilitate technology adoption, knowing that the age composition of the population is going to play a first order role in the speed of that adoption? And I think this is really where I actually don't really know the answer to that question. I mean, maybe it's about education. Maybe it's about changing the nature of the innovation itself. I mean, there are many things, many possibilities here. And contrary to the first question, I don't really have a good prior here. And so that feel like there is much more room for moving at least my priors, and in the extent that I might be representative, there might be plenty of room to move priors here. So I would really encourage the author to see whether they can provide some progress in that direction, because I think that would be extremely helpful and interesting. And last, and I think this was a bit the flavor of many of the questions in the chat, I think the paper could do a bit more in terms of discussing external validity in several directions. Are mobile payments special? I mean, I do believe so. I have a paper that illustrates one specificity, one particular benefit of mobile payments, which is to foster the access to credit. But that does not necessarily mean that they are representative of other technologies. And I think helping us position a bit better that technology, given that this paper is not that much finance as much as it is innovation, I think, at least that's how I take it. I think it will be very helpful to give a bit more color on how we should think exactly about how representative is that technology, also in terms of adoption along age. And then, I mean, India is it? I mean, geographically, is there something specific too? I think here, I mean, I view it more as like try to be ambitious. And you mentioned Brazil, but I'm thinking about Africa, for instance. I think Africa has very young populations, and so if you can convince me that this is directly valid to Africa, this is definitely of high interest to me. And then another question is like, can we take your result and do -1 for older country like Europe or some countries in Asia? And again, this is not necessarily immediate. And so discussing us and guiding us more in how we should think about applying this result across the globe, I think would be very interesting. And I understand you don't want to be a cross-country analysis, but just giving us more guidance here, I think would be very helpful. All right, so that's it on my end. I mean, I think it's a very nice and promising paper. I think it's still quite early, and there is still, I mean, it's a work in progress. But if anything, this is the best time to discuss it, right? And so, as I've mentioned, I think the paper would benefit a lot from being expanded a bit more, maybe, than deepened. And by that, I mean, I encourage you really to go for these less obvious implications of your work, both in the model and in the empirics. Then I understand you're facing trade-offs in how solidly you will be able to answer this. But I think here the trade-off would be really worth it towards expanding. And that's it on my end.